Hello and welcome to our August Outlook and Positioning video. My name is Derek Varner and I'm joined by my friend and colleague Mike Allison. Hello, Mike. How are you?
Yeah, I'm great, Derek. How are you?
Good, thank you. I think I first really want to talk about just how markets performed in the month of July. So we had a positive month from a return perspective across many asset classes. So the S&P 500 returned about 2%, but technology companies like NVIDIA, Microsoft, et cetera, really started to shine once again after a difficult April, as investors became more enthusiastic about the artificial intelligence build out, and some of those companies started to uh, uh, provide their Q2 earnings reports, which showed positive results and a lot of momentum around the artificial intelligence build out. But Mike, what did you see in July? What are your thoughts and takeaways?
I think, one of the things that really happened, beginning in May, continuing into June and through July is just a receding of sort of macro fears. The month of July was a very placid month. No major moves up or down. It was just sort of just inched its way forward with very low volatility. That could change as the summer progresses, but it seems like some of the macro risks, tariff and geopolitical and other risks, seem to recede into the background a little bit, and that's what provided for a pretty calm month in the markets.
You can see on the screen, this is the latest with respect to tariffs from different countries around the world. So again, some of this is evolving, but we see as of early August, the expectation is for Canada to be at about 35%, Mexico 25%, the European Union 15, China 30, India 25, and Japan 15. So I just highlighted some of our major trading partners, and that while that is higher than it was a year or so ago, it's lower than what was discussed in April during Liberation Day. So again, as Mike, as you said, I think the expectation was for something uh, much higher, much more challenging for markets and economies. And we've settled into kind of this anywhere from 15 to 25, 30% range. So what do you have any thoughts on the tariff front, Mike?
Yeah, I think that, it's right. Things are appearing to be less draconian than they might have otherwise earlier in the year, where people were fearing the impact of much higher tariffs. But one of the things that I think the market was reacting to in the month of July, for example, as we talked about sort of low volatility, is at least a little more certainty around what this looks like, as you just mentioned. The one thing that concerns me longer term is how all of this is being done through the executive branch, and the current administration, and another administration in the future could undo all this just by the same way
Stroke
they
of a
came
pen.
into being. Yeah, stroke of a pen. So to me, that leaves uncertainty longer term around that, unless this all gets codified with legislation. And my hope is for the stability of the global economy, among other things, that this does get codified, and it could always be amended. But you don't want to you go down this road, and businesses around the world, including in the U.S., sort of go on this assumption that this is how things are, and so they can operate their businesses around those expectations. But if you get whipsawed, that can only be bad news for the global economy. So that would be my sort of, if someone asked me what should be done, to me it should be enacted into legislation, so it gives a little more permanency to all this, and so that businesses around the world can operate with that certainty.
Yeah, I agree with you. And it's important to note that these tariffs we don't necessarily know who will be paying for the tariffs yet. So it might be some combination of foreign suppliers, companies doing the importing, as well as the ultimate end buyer, you and I. So, and the tariff amount is on the what's termed as the landed amount. So we've talked about this
Mhm.
in past updates, but a pair of Nike shoes from Vietnam hypothetically may cost the retail consumer $100, but the tariff is not on the retail price. It's actually on the cost for those to be imported, which is typically a fraction of the retail price. So these numbers look concerning, but again, we think that they're settling out into some reasonable range that markets have shown the ability and willingness to digest so far.
And
Uh,
at the margin, it might be a little bit inflationary, but not the kind of inflation that would, alter the course of, real GDP, for example.
So let's move to the big, beautiful bill. So we've talked a lot about in the past about deficits, and this bill certainly does, continue along the path of spending beyond what is, what we have. And so we'll have to do increased borrowing to fund the spending in the bill. But importantly, I think the certainty around passing the bill provided, markets with some increased stability. So there's some positive provisions in the bill, such as the ability for businesses to more quickly, get tax benefits from their research and development efforts. We've already seen that start to trickle in earnings discussions. So that's been positive. And we are also seeing tariffs potentially as a one source of funding some of this deficit gap. You see here from JP Morgan, as of July 31st, they account for tariffs being of roughly about $80 billion, which could increase throughout the rest of the year. But Mike, do you have any thoughts on the bill?
Yeah, I think it's easy to extrapolate in a linear fashion sort of what the impact of the bill would be. But there's some, non-obvious things as well. You mentioned tariffs, which remains to be seen uh, how meaningful the revenues are from that, but it's something. The other thing is, creating the ability for companies to expense their capital spending plans as opposed to amortizing, and so that's accelerating a lot of capital investment, private capital investment, and we'll talk more about the AI cycle, I'm sure, in a few moments. But the other thing that's inside this bill, some of it's fairly explicit, some of it's not so much, but there's a significant amount of deregulatory elements to the bill, and deregulation is generally deflationary, so it goes and offsets some of the inflation fears to the extent that you have deregulation, which accelerates growth, and so there's a scenario where the GDP accelerates because of this bill, and and can really help on the deficit front.
Yeah, let's hope you're right. That would be terrific. So you mentioned AI. Let's go there. So we'll go to AI next. At ChatGPT, we have on screen is seeing just r unprecedented growth, I think we should say, for a software tool. And in part, that unprecedented growth is leading to a big, big push for building out of these tools and abilities. And it's not just increased demand for computing, but it's increased demand for power in general. But I know, Mike, you did a wonderful piece in your Sunday Drive this week. So why don't you highlight what you're seeing on the artificial intelligence front, both in terms of the build out and your expectation for how it impacts the economy?
Yeah, we've written a few different things kind of in this realm. Obviously, it's top of mind for most folks, and I try to think of different ways to think about it that's not out in the stuff that people have already read. But we did do a piece on the demand for power, and in that infrastructure component of this super cycle, because the power demands are just accelerating in a in a almost exponential way. Historically, demand for electricity basically tracked along with GDP. But now you've got a scenario where because of the demand for power and data centers, AI oriented data centers, that you're bending the demand curve upwards. And so that's going to, put stress on the current traditional um, electric grid. So that's going to demand some serious investment, but also it's also going to lead to some innovation around the way that power is delivered, generated and delivered, that doesn't necessarily fit the traditional transmission grids of the electric industry. Um, The other thing we wrote recently is, this is a arguably, I don't think too many people argue this is a an infrastructure super cycle, just like we've lived through in telecoms in the 1990s, even the railroad build out in the 19th century. And what's a little bit different and to me kind of interesting is the previous super cycles for infrastructure build out have the railroad example and then the telecom example was for the most part funded externally by the capital markets. And this time, at least so far, it's being funded by the cash flows of the big names that you mentioned that we all know, the big spenders, Meta and Google um, and the like. And that's a possibility. There's a possibility that there's a little more spending discipline, even though it doesn't seem like it because the numbers are so big. But there's a bit of an arms race, a spending, arms race on this stuff. But also, all these companies have shareholders to answer to, and many of the senior management also are major shareholders. So, um, so I think there might be a little more discipline around the rate of spending, at least for the time being. And that makes this cycle just kind of different, not something we've seen before in terms of a broad infrastructure super cycle.
Well, I for one hope that that discipline leads to sustainability in the cycle because
As we all do.
we're big believers in artificial intelligence, as you said, being another technological revolution that, and hopefully we're still in the early innings of that. So, what do you do then, Mr. Allison, if you are the Federal Reserve and you've got this situation where you have the executive pushing for tariffs, which are, tend to be inflationary, the tech companies, as you said, pushing for big investment in data centers, which is probably inflationary. But we see in our most recent jobs report that hiring has slowed down. So you've got the Fed that's trying to balance controlling inflation, but keeping the economy, on a smooth path, making sure everyone that for the most part can have a job. That's the Fed's dual mandate is full employment and stable prices. So we've got this situation where prices aren't yet stable. We have some reasons to think that they could inflect upward, but the jobs, as of the most recent report, showed some pretty concerning numbers. So what do you do if you're the Fed?
I think a sustained period of positive uh, real interest rates in terms of Fed funds rate um, is ultimately going to be um, have a negative impact on the economy. And labor typically has been a lagging indicator. So what we're seeing right now, and there's a lot under the hood of these numbers. Um, it's not one can speculate, but no one knows for sure what's the impact of the slowdown in immigration on these numbers.
Right.
Um, there's a lot of factors above the head or below the headlines that are, coming into play here that we're not really clear on the magnitude of the impact. Same thing with the inflationary elements of tariffs, for example. Some people, their knee-jerk reaction is, oh, tariffs are inflationary. But the um, but the longer term knock-on effects might not be so. There's a demand response if prices are too high, for example. And a lot of these tariffs are in areas where goods they're highly um, price sensitive. So demand can decrease meaningfully, and that undoes any of the inflationary impacts of the tariff. So it's important to never just sort of extrapolate in a linear fashion because there's always puts and takes. And the other thing around inflation, which is also something we've written about, is inflation is just one number, but it's rolled up in from a number of different components, services, different types of services, goods, and one of the things over the last few decades is the service economy has shown uh, meaningful inflation. Cost of education, cost of healthcare being the two most notable. Goods, in particular, imported goods, have had a deflationary impact. TVs, software, the like. And so, to the extent that tariffs um, impact what has been traditionally a deflationary component of the overall inflation rate, um, that could go the other way, perhaps. And then there are also things that were have been inflationary and driven the rate of inflation higher. Services, um, you know, what impact can AI over the coming decades have
Mm.
on education and
What a great
healthcare?
point. That's great.
And so, the average is sort of 2.5 to 3, maybe 3.5 in the worst case scenario over time. Uh, I've always believed that the Fed's 2% target was unrealistic and still is. But 2.5 to 3 is a manageable and has historically been a manageable number. And but within that number, some things are inflationary or inflating, and some are deflating. And then the impact of changes in the economy, both from AI and tariffs and other things, demographics, can might alter the what has historically been a pretty predictable path for inflation. So bears watching all the pieces. Right.
Right. And I think that's what the Fed is trying to do. And they're seeking time to see how these things play out. Like you said, tariffs, AI, et cetera. But increasingly, they based on the most recent jobs report, they're maybe rightfully getting criticism for being too late to continue along the path to lower interest rates. So they're trying to get down to, kind of 3% for the Fed funds rate. And I think that, right now they still have a long way to go potentially. In summary, we're fairly neutral across the economy. We think the economy is generally in okay shape. We're seeing some cracks here and there. We talked about employment. Financial conditions, we're still in that wait and see mode. We think that the Fed will continue to lower interest rates, but they're watching for signs that the inflation genie is back in the bottle, we should say. And then lastly, on the valuation side, we're neutral here because some of the biggest companies in the world look a little bit expensive to us, but we're seeing a lot of, as you said, Mike, growth and healthy free cash flow, but also companies outside of the large technology group or the large growth group look reasonably priced to us, and earnings have been generally good. So we're advocating that clients hold a diversified portfolio that can lean in and lean out of lots of different areas when we see opportunities and risks. So not too much has changed from that perspective month over month, but I think that's the goal, is for this to be a good long-term all-weather strategy and portfolio that we put in place for clients. So Mike, any closing thoughts, any parting thoughts before we end this month's update?
No, I think we've just come through what has seasonally been a strong period in the markets, typically in the early summer months. Um, we're now coming into August, September, October timeframe, which historically has been a little more choppy. So wouldn't be surprised to see some of the recent strength, um, take a pause, if not pull back some to sort of work off some of this overbought, at least on the large cap side, overbought conditions. So, I would expect, both from a seasonal perspective, but also just given how far the market's come off its lows in April, to see a little more volatility and maybe not such an easy path for the second half for the rest of the year.
Yeah. Well, while it doesn't feel fun in the moment, that volatility creates opportunities. So we always secretly enjoy it a little bit because it helps us find things that are maybe attractively priced. So thank you, Mike, for your time and expertise and wisdom as always. And thank you all for watching this video. If you have questions, please reach out to us or your financial advisor, and we're happy to dive into these subjects in greater detail or walk through your specific portfolio. So thank you again, and thank you, Mike.
Thanks a lot, Derek.